Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Scarlet Fu.
And I'm Norah Mulinda, filling in for Paul Sweeney.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we look at one of the biggest mining deals in over a decade.
Plus, we'll look at why the Danish drug maker Novo Nordisk is cutting about 11% of its workforce.
But first, we begin with earnings from the computer tech company Oracle.
This week, the company gave an aggressive outlook for its cloud business, causing the stock to surge the most since 1992.
For more, guest host Alexis Christophorous and I were joined by Anurag Rana, Bloomberg Intelligence technology analyst. We first asked Anurag to break down Oracle's earnings and the company's major stock jump.
Oracle's a very unique company because it has your traditional software, but also a few years ago, it started a cloud business called Oracle Cloud Infrastructure, something very similar to what AWS does or Microsoft Azure. And one of the advantages it has is it just rents out its, servers for people to go out and train their AI models or run their applications on it. So this is really a new business for them, just came up the last few years, and that's where the biggest growth is, and that's what's driving the stock.
What's happening with the rest of the company, its operations, its software business? Is it still cutting costs, for instance, and reducing headcount?
The advantage Oracle has compared to, let's say, a company like CoreWeave or Nebius is that it has a very high margin database business and very high margin application business. These businesses have gross margins, let's say north of 90%. Now, when you marry that with a massive AI infrastructure business where you need to spend a lot of money, that's problematic for somebody that doesn't have that. But Oracle has that luxury that it can spend billions of dollars. Before we were thinking they're going to spend, somewhere in the low 30 billion range, which was already higher than what they had guided and, even the street was expecting. They came out and said they're going to spend over 35 billion in the next financial year. So that's a lot of money going into expanding data center, buying chips, creating a new infrastructure to fulfill this demand.
When you look at the competition here, Microsoft, Amazon, Alphabet, what does Oracle or how does Oracle differentiate itself, not only for the customer, the client, but for investors?
Yeah, and one of the things I would say is everybody is having a good time in this particular party. It's not just, one company that's gaining it. It's just the size of their business is far smaller than it is for, let's say, AWS or Microsoft. In the last financial year, their revenue was, roughly about 10 billion or so. AWS's run rate is like 125 billion. Microsoft's business is 75 billion. Google's business is 50 billion. So please, you got to take that with the context of how big Oracle's cloud infrastructure is compared to some of the bigger vendors out there.
Anurag, it feels like Oracle kind of came from out of nowhere with its contributions to the AI space and being such a big player. Certainly the bookings of almost $500 billion caught my eye, and it's more than 4 times what it was the same time last year. Are there any other kind of dark horses out there that you would be keeping your eye on that could be the next Oracle, which already feels like it's the next NVIDIA?
Yeah, I think one of the things you have to think about it is it's not easy to come up with this structure or a business like this because you need billions of dollars to create a data center or to lease out a data center, then buy equipment like NVIDIA chips and computing equipment. There are a handful of companies like, CoreWeave or Nebius, which are smaller neo-cloud players that specialize in renting NVIDIA GPUs to customers. Now, the bigger vendors have the capital that they are also expanding it. But again, as I said, given the size of the increment that they are seeing, you're not getting that same growth rate.
Do you think there's a little over-exuberance, though, in the market, especially with so much talk about whether or not we are in an AI bubble and what happens if it starts to deflate?
Yeah, see, one of the things you have to remember is for Oracle at least, they have this backlog of orders coming in. And it's coming, for example, one of their biggest customers right now is OpenAI. If OpenAI continues to expand revenue at a good pace over the next several years, they are going to be spending a lot of money to train their models in order to stay ahead. So I think there is a lot of relationship over there. If, let's say, you and I don't use ChatGPT as much, that would have an impact on OpenAI's revenue. That would have impact downstream revenue on all the other players, whether that's NVIDIA or Oracle. But frankly speaking, we are not there yet.
It doesn't feel like this is a situation where it's a zero-sum game. Oracle wins and Microsoft, Google, and Amazon lose. Or is it?
No, so there are a few companies that fall into this bucket, and those include Amazon Web Services, Microsoft, Google Cloud, CoreWeave, Oracle, and Nebius, for example. So these are the ones that are seeing extra spending right now. But when you look at on the application side, whether that's Salesforce or Workday, those guys are not seeing that benefit because they're not in that infrastructure game. So there's a huge difference between the two vendors or between the two category of vendors. Right now, we are more in the build phase of AI, not the implementation phase of AI.
It's hard to believe, Scarlet, but this stock is now worth has a larger market cap than Walmart, Eli Lilly, JP Morgan Chase.
Yeah, that is pretty remarkable. And again, it feels like it kind of came from out of nowhere.
You're right on that.
Very recently.
Which is why I brought up, Amazon, Microsoft, right, Anurag? I mean, the fact that those were the names we were really talking about when it came to AI. And then sort of Oracle comes out of the blue.
Yeah, but that's the whole point. This particular infrastructure, if you're going to run large models, it's very unlikely you're going to do it in-house. I mean, you can do it, but you require a lot of investment going in. You're better off renting out data center capacity or computing capacity from one of the cloud vendors. And Oracle has the money to spend it. And they have the relationship with NVIDIA to get those GPUs. And on top of that, they're offering this to customers and saying, here's my equipment, come and test it out the way you like it. Amazon, on the other hand, for example, sells it as a package. And that's where you're seeing some distinction and also the size, as I mentioned before.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
We move next to news in the telecommunications space.
This week, the space tech company SpaceX agreed to buy wireless spectrum from EchoStar for about $17 billion in cash and stock.
And this comes weeks after EchoStar agreed to sell spectrum licenses to AT&T for about $23 billion in an all-cash transaction.
For more, guest host Alexis Christoforous was joined by John Butler, Bloomberg Intelligence Senior Telecom Analyst. We first asked John how this deal will help SpaceX.
So the key to this deal is spectrum called AWS-4. So if you look at Starlink and its rivals in the satellite space, they all hold spectrum, but they're not allowed to offer wireless services over that spectrum. AWS-4 spectrum, according to the FCC, can be used flexibly. It's called flexible use spectrum, meaning the satellite providers can offer anything from mobile services to satellite data downlink services, video, whatever. It's open use spectrum, if you want to think of it that way. And so Starlink getting its hands on this key spectrum will allow them at some point in the future to potentially enter the wireless market as a competitor to AT&T, Verizon, and T-Mobile.
So EchoStar's shareholders seem to like this deal. What are they going to do with the proceeds? What will EchoStar do with the proceeds of the sale?
So for EchoStar, it's a very good deal as well. They have really struggled to get their wireless service off the ground. They've been building this 5G wireless network and have a relatively weak prepaid brand called Boost, and they've really struggled there. So this brings in much needed funds for them to pay down debt. They've been a bit stretched on that front, over leveraged. And, this deal together with a deal a couple of weeks ago with AT&T is going to bring in billions of dollars to reduce debt. That's number one. And number two, it brings in fresh capital for them to invest in the business. And I have a feeling they're probably going to take a step back and reevaluate the strategy here based on the fresh funding and decide what the best avenues of growth may be going forward.
I'm wondering if this is going to satisfy the FCC, this deal, because I know that they were sort of on EchoStar's case, if you will. They wanted them to sell some of their airwaves as the company looks to roll out its 5G technology. I know they sold some spectrum licenses to AT&T recently. So do you think this is going to sort of take the FCC off their backs?
I do. I mean, I think Starlink was working with the FCC. They had written a letter about EchoStar's underuse of the spectrum. Starlink obviously really wants to get their hands on it. And I think the FCC really took their side on this one. I think they understood that EchoStar, being the only owner of this flexible use spectrum, had not really put it to use to date. So in their view, it was being underutilized, and being such a critical asset, felt that, a sale might make sense. And so they really, EchoStar really got into it with the FCC, trying to protect those licenses. But in the end here, I think if you want to think of it this way, the FCC won the day. And net, I think it's a good deal for both EchoStar and Starlink and the FCC.
Now, I know SpaceX or Starlink had a deal with T-Mobile, right? How is this spectrum acquisition with EchoStar different, if at all?
So I think ultimately Starlink could go from being a partner with T-Mobile to being a competitor of T-Mobile's. As I said a moment ago, this spectrum opens the door for them to get into wireless directly without having to partner with a terrestrial carrier. The current deal with T-Mobile basically has Starlink. I think the best way to think about it is they're almost like a tower company. They're providing the space-based cell sites, if you will, to carry T-Mobile traffic, and they get paid a fee for that, but they're not earning the level of profits that you could as a direct carrier. So down the road, Starlink, understanding this, wants to enter the cellular business directly. They have a lot to do before that happens, but I think it longer term puts the deal with T-Mobile in jeopardy.
Is $17 billion a fair price for these spectrum licenses, do you think?
Spectrum's a very illiquid market, so it's tough to gauge valuation. But in my mind, I look at it as a fair price, given the potential, again, for Starlink to enter this huge market down the road.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
Coming up, we'll look at how the U.S.'s ability to assess data on climate change is being impacted by the Trump administration.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Scarlet Fu. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
I'm Scarlet Fu.
And I'm Norah Mulinda, filling in for Paul Sweeney. We move next to a major deal in the mining industry.
This week, the global mining company Anglo American agreed to acquire Canada's natural resource company Teck Resources.
It's a so-called zero premium deal, and this deal would create a more than $50 billion company and one of the biggest mining deals in over a decade.
So for more, guest host Alexis Christophorous and I were joined by Richard Bourke, Bloomberg Intelligence Senior Basic Materials Analyst. We first asked Richard what a zero premium transaction actually is.
So what they've done is it's a merger of equals, and it's kind of interesting, even though it's labeled a merger of equal, that American Anglo shareholders are going to end up owning about 2/3 of the company roughly, and Teck shareholders going to end up owning 1/3 of the company. But it's going to be headquartered in Canada. The board is going to be 50-50, and the management's going to be 50-50. So even though it's kind of nil premium merger equals, kind of, the governance issues kind of point to a merger equals, and that's really probably structured in order to get approval by the Investment Act, Canada Investment Act, and also the Kevel family that owns. Teck has two classes of shareholders, Class A and Class B. Class A is super voting rights. He owns a majority of those shares. So he has to approve this deal. In the past, Glencore, when Glencore tried to buy them about 2 years ago, he kind of vetoed the deal, so the deal didn't go through. So there's kind of a unique structure of this deal to kind of, fit it through final approval.
Makes sense.
Okay, so there was also language in the statement of this so-called merger of equals that would allow both firms to consider unsolicited proposals and for the deal to end if there's a better offer. Does that mean they're angling for some counteroffer from someone else?
Well, I think it would be a hard press. I doubt, in order to get it through the Canadian Investment Act, which copper is now being considered a critical mineral. Canada has said they don't want to see any of their mining companies go away. So would somebody come in who can pay that much, be willing, or a BHP or Rio Tinto, be willing to move their headquarters from where they're at to Canada? I highly doubt it. So, but I think you have to put that language in the deal that, hey, we're open to.
So it's like boilerplate language
Yeah,
more than anything
boilerplate, and
else.
also prevent that you don't get sued by shareholders that you haven't gone out and looked at for all deals.
Right. Do you think that this deal, though, between Anglo American and Teck is going to be the thing that sort of ignites more M&A in this industry?
I think, there used to be an old saying, I used to cover the oil and gas industry years ago before I more focused on metals and mining. There used to be an old saying, it's cheaper to drill on Wall Street than drill out there in the field. And that seems to be happening if you look at how much it costs to, get a new copper deposit up and running, also how many years with permitting and all the other things that happens, you can see that maybe you sit down and look at this and say, okay, it may be cheaper to mine on Wall Street than go out and make a mine.
Our thanks to Richard Bourke, Bloomberg Intelligence Senior Basic Materials Analyst.
We now move to some news in the pharmaceutical space.
This week, the Danish drug maker Novo Nordisk announced it's cutting 9,000 jobs globally. This equals about 11% of its workforce. The company also cut its profit forecast for the third time this year as it fights to recover ground in the obesity drug market.
For more on this, guest host Alexis Christoforous and I turn to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. We began by asking Sam to talk about the larger changes taking place at Novo.
The story here is that this is not the first time they've lowered guidance for the year. I mean, this time there's an impact on the EPS front from obviously the costs of restructuring, assuming they can get it all done this year. But it's a pretty chunky one, 9,000 people, about 11% of the workforce, and a lot of that coming from Denmark. If you read the essence of the press release that they put out, there's a couple of things that they bring out. They want to invest more on R&D. Well, what I think this is telling you is that the growth that they had planned for the next 5 years, they may be thinking maybe that won't come as fast as we were expecting it because of competition from Lilly, compounders, and other products potentially coming to market to the pace that they were hoping. So if you want to keep investing in R&D, you need to liberate some cash. And also, it looks like that they're also thinking about changing the way that they're doing their marketing because of the different channels that they're getting involved with now, direct to consumer. That is not something that pharma has done very often before. In fact, only Lilly had done it prior to this, also for an obesity drug. So maybe the costs of that are different. And there's an element that they've referred to in there, which is a culture of performance-related reward. And you think to yourself, well, what was it before? So it seems like that they want to make it much harder focus on you've got to deliver because we need the growth. So that's interesting all to watch.
Sam, I think to a lot of casual investors who don't deep dive into, Novo Nordisk the way you might say, would look at this and say, listen, they have the most popular weight loss drugs, right? Wegovy, Ozempic. Why is this company having these problems? When you drill down, or is it just a problem with having to scale too quickly? Is it that the company isn't nimble enough to sort of change with the times?
Well, Novo Nordisk has been a poster child of how you grow from a small company selling to a relatively basic set of products 20, 30 years ago to one that's become essentially one of the innovators in the space. They brought the first GLP-1 to market. So we can't fault them for that. It's just that I think this growth that they had to go through where the planning was done, we have $100 billion market potential for obesity as a whole, right? So it's just difficult, I think, to judge into this space. And maybe the previous CEO had looked and said, I'm pretty sure we're going to be 50% of that market. We need to plan for that growth. And then two things changed. Competition from Lilly is super intense. They have what I would call a better drug in terms of the efficacy profile that's been shown in head-to-head trials. And then, of course, you've got on top of that compounders that don't seem to be going away. They keep taking cheaper generics, or not generics, manufactured elsewhere and making the drugs. So that's where I think the new area issue is, in that we all expected the FDA to really clamp hard down on that, and they haven't.
Right.
They've made issue, statements, but they're allowing them. They even found areas outside the U.S. where these compounders can get their drugs from, which is counterintuitive.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
This week, we focus on a Bloomberg Big Take story entitled, Trump is Unwinding Climate Science at a Dangerous Pace. You can find it on Bloomberg.com and The Terminal.
The story looks at how mass firings, regulatory rollbacks, program closures, and funding cuts across agencies have threatened the U.S.'s ability to gather and assess data on climate change. And this is under the current Trump administration.
For more, guest host Alexis Christoforous and I were joined by Eric Roston, Bloomberg climate reporter. We began by asking Eric to explain how President Trump's policies are impacting the ability to gather data.
Whether you are a mayor of a city or head of an insurance company or head of an agriculture company, everyone throughout the economy, public or private sector, needs good information to make good decisions. And the U.S. in recent decades has had the global leadership role in developing the kinds of data that everybody needs in order to see what's coming, to set insurance rates, to understand whether we should build a house here, to understand if this floodplain is going to be like a bad place to build houses. And so that's the data we're talking about here, is actionable data that people in the economy have come to rely on to make decisions. To cite one of the many examples we talk about in the story, the U.S. produces, it's supposed to be not more than every 4 years, a national climate assessment, which is a huge
amount of time, right?
A huge amount of time. They take years to develop, hundreds of people to write, and thousands of papers that they're based on. And you see these reports cited in Travelers' earning calls and Chipotle earning calls and reports, and Marriott. Brands we see every day understand the material and understand the needs of this material. I'm not putting words in their mouth. I'm just pointing out that they say things like this. Those were taken away from public view. So I think that's an interesting place to start on, because, the government, any government, can be cut, right, and save money. And it's just the nature of bureaucracy. But why are some of the most authoritative and well-vetted scientific reports ever written being taken away from public view, where they've been for many years?
All good questions, and I'm sure that we won't get answers to them right away either. So what does it mean if you're a company like Travelers and you're relying on that data? Can you go to private sources for that kind of information? Does that exist?
That's a great question. And if we had another 2 hours, I'd love to, because we've spent a lot of time in the last few years on the private sector's, filling a hole in useful climate data that businesses need. So the short answer is yes. Some of this data, a lot of it is translated into the language of risk for companies. It does exist. The bigger concern is that's a tiny fraction of what we're talking about here. Mm-hmm. We're talking about very sophisticated computer models that the entire world relies on to make sense of observations we see in weather stations and in other sources. And in a particularly, I don't know, I'll get in trouble for saying this, but this could be described as the most boring kind of data, is also some of the most important. And that is...
it's unsexy data.
Unsexy data is continuous monitoring data. Mm-hmm. It's very important for some kinds of data that you have a complete unbroken record. The most iconic one in this space is the CO2 measurements from Hawaii on Mauna Loa that have been going on since the late 1950s and are largely responsible for the discovery of global warming. Like that data set, one of the most famous data sets ever collected, was slated for closure in the recent White House budget.
Our thanks to Eric Roston, Bloomberg climate reporter. Coming up, a look ahead to a potentially big M&A deal in the banking sector.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Scarlet Fu. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
I'm Scarlet Fu.
And I'm Norah Mulinda, filling in for Paul Sweeney. We move to some news in the banking sector.
This week, PNC Financial Services agreed to buy FirstBank for about $4.1 billion, adding more than $26 billion in assets and branches in Colorado and Arizona.
The acquisition will triple the number of PNC branches in Colorado, and it will give the combined company more than 15% of deposits in the state.
Guest host Alexis Christoforous and I were joined by Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks. We first asked Herman if bank regulators are going to be okay with a deal of this size.
The regulatory landscape has been really great for banking and getting bank deals done. That's why you've seen some more bank deals over the past couple months. You saw Huntington, which is based in Ohio, go into Texas for Veritex. And you've seen a merger of equals in the Southeast with Synovus and Pinnacle. And this is sort of like the third large regional bank deal over the past couple months. So it just sort of signals that the Trump administration is really open for bank M&A.
And this is not PNC's first attempt at really expanding its Colorado presence. It had previously sought to open 16 locations in Colorado. Why is Colorado such a hot market for PNC?
Right. I would take a step back and sort of highlight that the PNC, which is mostly in the Northeast, Mid-Atlantic, Midwest, that they've expanded across the Sunbelt states and Colorado with the 2021 deal for BBVA USA. And they sort of double down on those markets with this expansion plan to grow organically by opening up new branches. And this deal that they announced really sort of supports that growth and accelerates it in Colorado and in Arizona.
So I'm just wondering, as you look out onto the landscape now, who might be the next takeover candidate? Who might we be talking about in the not too distant future?
Yeah, so you've seen some of these deals where these slower growth Midwest banks grow into areas like Texas, Florida, Colorado. So the banks that are sort of smaller in size, and we're talking about FirstBank's about 20 billion in assets. So banks of slimmer of that size in these higher growth markets are really attractive to some of these larger institutions.
So with this purchase, PNC's total assets approaches $600 billion. It will bring it closer to the number one regional bank, which is U.S. Bancorp. Is U.S. Bancorp still a regional bank, Herman?
Yeah,
it is?
I would say there are three super regional banks, and I would put PNC, U.S. Bancorp, and Truist, where they're sort of below that 750 mark, but larger than your typical regional bank. And they PNC now is a coast-to-coast lender, and have operations all from the Northeast all the way down to Florida, Texas, California. So you can't really call them a regional bank at this point. I would view them as more super regional.
And I want to tie it back to the Fed and interest rates, because don't all roads really lead there at this point? And
that's right.
Want to talk about what, again, if this is going to be an environment of lower interest rates for the foreseeable future, what is this going to mean for the banks, but especially these smaller regional banks? Because I'm thinking it may even squeeze their profitability more.
Yeah, it's interesting because we had a few Fed rate cuts at the end of last year. And the regional banks that I cover were able to navigate that pretty well. They're able to keep their net interest margins, which is a key metric for profitability, fairly stable. And that's one of the reasons why they've been able to do that, is they've been able to lower their deposit costs, which was one of the things that really is a key metric for banks to really show top line growth. On top of that, lower interest rates could help loan growth. You've seen some companies like Rocket's mortgage be very ebullient for lower interest rates, and so that could help improve some of the demand for lending, and that's something that we're seeing so far over the first half of the year.
So they'll make it up in volume. What they lose in profitability, they plan to make up in volume.
They can make it in volume. You'll see some dents in like the rates that they charge for loans, but they'll also make it up in volume and lowering their funding costs.
When you look at the landscape overall of M&A in the banking sector, it feels like we've been waiting for something to happen for a long time. And maybe this is kind of the first domino that falls.
Yeah.
Will the big banks, and I'm talking about the JP Morgans, the Bank of Americas, Wells Fargo's, will they play any role in this consolidation?
They're already too big. So there's they are prohibited from doing such deals because they just have dominant market share in their markets. One thing that we did see during the height of the regional banking crisis a couple years back is that JP Morgan bought First Republic in an FDIC failed bank acquisition. So if we, in the sense that if we do get to a place like that, that's when the big banks can play. But in a straight M&A type scenario,
to clean up messes, they can clean up
messes, but they can't outwardly buy a bank at this point. They're just way too big.
And just what about the consumer out there only shopping for the best deal? You know, it used to be that these smaller regional banks would be the place to go for the better CD rates, right? Or a more friendly mortgage terms. Is that still the case?
Yeah, sure. So that's what really great about these markets that PNC is going to, where they can have really dominant market share in Denver and Arizona, and just having that marketing and having the branches really helps with deposit taking and helping your consumer out.
Our thanks to Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
This week, we focused on another Bloomberg Big Take story entitled Tesla's Dangerous Door Design Can Trap People Inside. You can find it on Bloomberg.com and the terminal.
This story looks at how some of Tesla's design features, like door handles, are confusing occupants and first responders. And this is worsening injuries and damage caused by survivable crashes.
So for more on this, guest host Alexis Christoforous and I were joined by Craig Trudell, Bloomberg Global Autos editor. We began by asking Craig to give us his main takeaways from this story.
This is a company that, from the beginning, you've heard Musk talk about, just how safe his vehicles are. And, even just very recently, the company has posted on X, if you love them, put them in a Tesla. That's the kind of language that you see and hear from Tesla and from Musk. I think what happened here with the doors is, sort of from the beginning, an attempt to kind of innovate what I think Tesla's critics would say didn't need innovating. We didn't need to change the way that, a door opens and closes. It's intuitive. Everyone knows how to do it. You sort of know how to do it when you're 3 or 4 years old. The company wanted to go to this, new, different sort of path-breaking approach of handles that would be flush to the doors for better aerodynamics, and also, if you think about a battery-powered car, it's very quiet, right? You don't have engine noise to drown out any sort of whistles or anything like that. So the smoother the surfaces, the flatter everything, the better in terms of not just aerodynamics, but also this sort of getting rid of any noise. And so while those all, are understandable reasons to sort of make some design changes, what we found in the course of reporting of this story is just, some sort of tragic consequences of those decisions in terms of, how difficult it is, both for you as an occupant to get out and also for first responders to get to you, to open the doors and get to you in situations where maybe you're incapacitated or you're having trouble with the doors.
Yeah, I mean, the stories that you highlight, Craig, were really eye-popping and disturbing. I mean, a little 18-month-old girl was stuck in the car. Her parents couldn't get her out. And that was one of the better stories. It had a better ending. They were able to get her out. I mean, I'm surprised that the National Highway Traffic Safety Administration isn't really cracking down on Tesla. What are they saying about all of this?
I think that was one of the more interesting, issues with this story is that NHTSA, a lot of complaints, a lot of safety concerns come across their proverbial desk, if you will, and at times it will take all of a single complaint or a handful of owner surveys that will sort of get its attention and lead to communication with manufacturers of, hey, you need to take a look at this, and sort of the agency will sort of put its thumb on the scale in terms of a potential recall. In the case of this story, what NHTSA told us is that they are in communication with Tesla to gather additional data and determine whether a, quote, full investigation, unquote, is warranted. That does allude to this idea that there may be some sort of initial investigating going on, but in terms of a formal probe, that has not been initiated, at least as of yet.
Okay, so that's where the regulators stand. What's interesting to me as well is that other EV makers have kind of taken Tesla's design and copied it. They are also doing the same thing. So this now goes beyond Tesla vehicles, doesn't it?
Yeah, and I think what was interesting to us and sort of, kind of trying to get a sense for just how problematic this is for other manufacturers, I think, there was nothing that stood out more for me was, looking at J.D. Power's study that they do every year. It's called the Initial Quality Study, IQS. You might be familiar with car companies, making this, a point of emphasis in their ads or their commercials when they do well in that study. And in 2023, they had a record high number of problems per U.S. vehicle in the U.S. market. And one of the things that they pointed to as a reason for this was doors. And they kind of poked fun a little bit at the industry that they, researched by saying this wasn't something that we needed to change. It was working. We weren't getting complaints from people that we survey for this study. And now this is a percolating problem area was the phrasing that they used. And 7 of the 10 most problematic models in this respect were EVs. So what we're seeing is a lot of taking after Tesla in terms of door design. And for the most part, what we're seeing is copycatting or taking after EV for EV, right? Trying to field a Model Y fighter that also has, doors that are similar to the Model Y.
I'm wondering, I don't think your story got into the story got into this, Craig, but what's the legal ramifications here for Tesla? I would imagine the lawsuits are piling up. I mean, if my child was stuck in a Tesla and I couldn't get him out, I might be suing Tesla.
We are aware of a handful of lawsuits, and I think, one of the complicating factors here is Tesla pushes its customers into arbitration for these sorts of suits, that this is part of the sort of purchase agreement when you buy a Tesla. That is something that, litigants are going to have to sort of overcome because of that sort of policy on the part of the company. I think another sort of complicating factor here is that, one of the, a couple that we speak with in this story, they had no inclination to sue Tesla immediately after the crash. It took one of the first responders coming to them after the fact and saying, hey, we really had a hard time getting to you, and it was because of your vehicle. Mm-hmm. That is part of the issue here. You don't necessarily know right off the bat, hey, something wasn't right here. I need to do some investigating.
Our thanks to Craig Trudell, Bloomberg Global Autos editor.
That is this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BIGO on the terminal. I'm Norah Mulinda.
And I'm Scarlet Fu. Stay with us. Today's top stories and global business headlines are coming up right now.